It's already 2 p.m. here in San Francisco Bay Area. So I think we can start. So happy Friday, everyone. Welcome to our learning session. I'm Alex, co-founder of Nauma. We're building modern financial planning tools for people in tech. And we help navigate complexity of equity compensation, taxes, investing, and set long-term goals to give people clarity and control over their financial future. When we don't write code and serve our clients, we run personal finance learning sessions and talk to interesting people. Today, we are joined by Karsten Jeske, a leading voice in the personal finance and early retirement community. Karsten previously taught economics at Emory University and worked at the Federal Reserve Bank of Atlanta, as well as BNY Mellon Asset Management in San Francisco. Karsten has Ph.D. in economics from the University of Minnesota, and he also holds the Chartered Financial Analyst designation. In 2018, he achieved financial independence and early retirement. And since then, he's been running a highly aggregated blog, earlyRetirementNow.com, very well known for the Safe Withdrawal Rate series, one of the most comprehensive analysis of retirement planning available online. Karsten combines academic rigor with a practical experience, helping thousands of people better understand retirement planning, sequence risk, and sustainable withdrawals. We're excited to have him today to share his insights. Karsten, really glad to have you with us. Where are you joining from today?
I live in Washington State, and I am just across the state line from Portland, Oregon. So I'm in the southwest corner of Washington State.
Wonderful. How long have you been living there?
So I retired in 2018, and then we moved here after my retirement. So I wanted to stay on the West Coast. So.
That's great. So today's session will be in an interview format. I prepared a list of questions for Karsten based on what people submitted during the sign-up. We'll aim to cover these in the next 30 minutes and then open it up for live questions to keep things more fun and interactive. With that, let me start by asking Karsten, what are the most common mistakes when people think about the 4% rule or apply it?
Well, I mean, the 4% rule is probably a good average and a good rule of thumb to start with. So if you are, say, 10 years away from retirement and you are looking for, well, what's even a rough guesstimate number of the nest egg I need, then you can do this. Basically, 1/4% is 25x. So 25x annual expenses, that should be your nest egg target. But once you get closer to retirement, you should probably personalize this more, right? So for example, if you're an extremely early retiree, right, and you retire in your early 30s, and you have a much longer retirement horizon, maybe 4% is too aggressive. And then others, say, a lot of people retire, say, in their late 40s, early 50s, which is still vastly early retirement compared to the average retirement age in the US. You might have Social Security around the corner. You might have pensions they may not start at the same time as your retirement, but they come in later. And at that time, you might be able to lower your withdrawals. And so if you factor that in, maybe with the 4% rule, you're really shortchanging yourself. So it's basically a 4% rule. It could, in practice, mean anything between, say, 2.8 and 6%. And so that's a really wide range. And so your savings target would be very different depending on what kind of idiosyncratic parameters you have. And this is just the idiosyncratic stuff, right? I mean, you can also ask, how about market conditions, right? If we are close to the market peak, as we are right now, you want to tread a little bit more cautiously. And if the stock market is already down by 20, 30, 40%, you don't have to calibrate your withdrawal rate again to the absolute worst case historical cohorts, right? Because if the market is down already substantially, we are not going to tag on another Great Depression or another 1960s, 70s, 80s to that. So again, once you get closer to retirement, fine-tune that and don't rely on this naive 4% rule.
The range that you just mentioned, between 2.8% and 6%. So for you, the biggest, the largest withdrawal would be around 6%. Some people online talk even about higher, like Dave Ramsey is something. I think he suggests 7 or 8%. What's your take on that?
Well, and again, I mean, there is no upper limit, right? If you are expecting some kind of a deferred compensation package that is paid out 5 years into retirement. So, for example, I had another 3 years of deferred compensation that was paid out over my first 3 years of retirement. So it was pretty substantial. So there's really no upper limit, right? If you think that you are going to cash out and you're going to get another $10 million in 5 years, then your withdrawal rate compared to today's asset value might even be higher. Now, Dave Ramsey is obviously making this mistake of tying the withdrawal rate to some kind of average historical S&P 500 return. And you, to his credit, I think he was targeting the real return. So he takes, he says something like 10 to 12% nominal. You chop off maybe 4% inflation. Boom, you're at 8%. It's actually 8% real return for the S&P is a little bit aggressive. I think 7% is if you want a round number, it's 7%. But 7% is still a little bit aggressive, and that's because of sequence of return risk, right? If you do the initial withdrawal too aggressively, and you have a downturn right out of the gates during your retirement, you may not be able to keep that spending level, and you might basically have to cut your spending short just as much as your equity portfolio is down. So not everybody can sustain that. So. And again, I'm not saying that there is one fixed upper limit, but certainly the 8% Dave Ramsey number, that seems a little bit off.
Yeah, makes sense. Thanks for sharing that. And in your blog, you were saying that 4% rule is a good starting point, and what you just said. But your personal research has shown that certain idiosyncratic factors can significantly alter that target. So what is idiosyncratic?
So idiosyncratic is actually kind of I think it's not typically economics lingo, but I think it is mostly econ lingo. So it means something personal, something idiosyncratic, personal to you. So that's what I mean. It would be your age, would be your, say, family history of longevity. It would be any kind of supplemental cash flows that you expect in the future. It would be, what is your target for leaving an estate, right? Are you willing to deplete your portfolio? Do you want to keep maybe not the entire corpus of your initial portfolio, but you maybe want to leave something to your kids over time, either by the time you die or over time, right? Maybe help your kids when they still need it the most, not when I am 90 and I die, and then your kid is already in the 40s and 50s and 60s, when they maybe might have needed some money before. So this is idiosyncratic, means so specific to you and your personal situation.
Yeah, thanks for clarifying that. And in your series, you often mention Shiller compare ratio. What is that, and how does it affect safe withdrawal rates?
Right. So Shiller CAPE stands for cyclically adjusted price earnings ratio, right? And we everybody knows a price earnings ratio, right? I mean, you can go to any corporation on Yahoo Finance and you see the annual earnings and you see the price. You can calculate the price earnings ratio. And basically Shiller proposed calculating the price earnings ratio, not just for a company, but also the index. And then the other proposal he had was, instead of doing basically just a one-time snapshot for 1 year earning, he's looking at a 10-year rolling window of earnings. So it's basically, you would smooth out all the economic fluctuations over time. So this is why it's called cyclically adjusted, because hopefully 10 years rolling smooths out over expansions and recessions. And so basically, what's the multiple? How many times is the price of the S&P 500 overall relative to, say, 10-year rolling earnings? And then what you found is that if you look at the this price earnings ratio, it has some predictive power for future returns. And it's not predicting returns tomorrow or the next month or even year, but certainly 10-year real earnings going forward are definitely very correlated with the Shiller CAPE. And again, so the Shiller CAPE is probably, it's a really very, very low-tech valuation measure to tell you how expensive or cheap the equity market is very low-tech. when I used to work at Bank of New York Mellon, I mean, we would basically scoff at using the Shiller cap. Right? We had our own proprietary in-house valuation measures, and they didn't rely on 10-year backward looking. They had our own earnings forecasts in there. It was basically a forward-looking measure. But as so often, it's one of these Pareto principle things, right? So the 80-20, you get 80% of the outcome with 20% of the effort. And by the way, I think in terms of the Shiller Cape, it's actually 80% of the outcome with 0.00002% of the effort, because it's so simple and so trivial to construct.
And it's available online for everyone.
Right, it's available online. Shiller publishes it. I publish it on my blog. I have a little bit of an adjusted measure where I take out some of the basically shortcomings of the Shiller Cape. So, for example, there are different regimes of corporate taxes that could make a difference. Makes the Shiller Cape not as comparable over time. And then
that's a very good point. Yeah, because taxation of the business has changed.
Exactly. And then also different payout ratios. So how much of the corporate earnings are paid out as a dividend versus reinvested internally. Amazing. I can't get into the details. We could spend a whole hour just on that. But that could also make a difference and makes the Cape a little bit less comparable. And if you make an adjustment for that, that's what I do in one of my blog posts. So yeah.
Speaking of high valuations, the average analyzed S&P 500 return during your 18 years of accumulation from 2000 to 2018 was only 3.2%.
Right.
Despite that, you were able to retire successfully.
Right.
Do high valuations hurt more people in their wealth accumulation or wealth preservation stages? What is your opinion?
Right. So, and it's not my opinion. So it's basically pretty much statistical hard facts. So initial valuations matter less for people starting out and accumulating assets. And I experienced that myself, right? As you said, the point-to-point return was actually quite underwhelming. But right out of the gates, so my first job was actually in September 2000, right? I was right at the peak of the stock market there. I started investing in my 401k when I was at the Federal Reserve. And so basically the first few months of contributions were just terrible, right? I mean, you couldn't contribute fast enough, and your balance goes down even though you put money in. And then the same thing, I got a big pay raise going from the Fed to the private sector in 2008, right around another big market drop. And even though it's not very pleasant in real time when you go through this, but you get this beneficial effect of dollar cost averaging. Right? So I bought and religiously and meticulously and diligently bought more shares as the market was down. And so the point-to-point return looked really awful, but the point-to-point return saved from some of the contributions that I made in March of 2009. Right, when the S&P 500 was at 660 points to today, that looks really good. And if you average over all of them, suddenly your true internal rate of return actually looks much better that way.
Yeah, that's true, because there is a volatility, right, during that process, during that period. And actually, we sometimes buy stocks at the lower price. Matthias is asking, do you use CAPE for international stocks?
I have a little bit of international exposure. And so in the United States, we are in this very, I don't know if it's a very pleasant or unpleasant situation that it's pretty much our stock market is highly correlated with the rest of the world. Right? And certainly over the last 10 years, your international stocks would have vastly underperformed. Year to date, international stocks did much better than US stocks. It's not so much because the other stock markets did so well, it's pretty much because of dollar depreciation. So you have some exchange rate risk in there, and then sometimes the exchange rate risk works against you, sometimes it works in favor. So I'm probably a little bit underinvested on the domestic versus international stock. Some people, they say, no, I mean, you have to do it exactly in the shares that the foreign market makes up. And by the way, even that right now, I think it's something like 2/3 US, 1/3 international, just because this is how big the US market has become. And but I also don't blame people for avoiding international stocks, because they say, you look, and that would basically be now a tactical asset allocation decision, right? Where people say, well, I believe that the growth is going to come from the US. Other countries are, and by the way, people also compare the CAPE ratio from other countries, and they look much cheaper than the US. Well, they're cheaper, but they might also be cheaper for a reason, right? There's less growth. So again, especially the CAPE ratio, when you look only at the 10-year rolling backwards, I want to look at the forward-looking earnings. If you look at the forward-looking earnings, actually, US may not be as crazy overvalued as some people want to make it. So I can see both ways, and I'm somewhere in between.
Basically, expectation, right, that the market will grow. Right. And may I ask you, how does the length of the withdrawal period affect safe withdrawal rates?
Right. So we have another situation where we face that exact same problem, right? So for example, the question between a 15-year mortgage and a 30-year mortgage, right? And I think maybe people are now proposing have even longer mortgages. So if you increase the mortgage duration by 2x, you don't lower the mortgage payment by 50%, right? So it's actually a 30-year mortgage is a substantially less payment as a 15-year mortgage, but is substantially more than half, right? And so as I think of that in amortization math, it's not really linear in the duration. So that means, so it's actually really good news for us early retirees, because there's some people touring around there who say, well, if you have, say, a 60-year horizon, you need twice as much money. Of course, that's not true, right? Because think of a 60-year retirement as 2 30-year tack on top of each other or back to back. For the second 30 years, right, for the years 31 through 60, you don't have to set aside as the same amount of money as for your initial 30 years, just because time value of money. And it turns out that doubling your retirement horizon, you don't have to cut your retirement withdrawals by 50%. You may only have to cut it by, say, somewhere between 15 to 20%, which was really good news. So that, because I had thought when I first started this research, if you had retired at the top right before the Great Depression, 60-year retirement would have been impossible. Right, because it's so long and so many bad shocks happened between, say, 1929 and 1989, right? The Great Depression, the crazy 60s and 70s and 80s. And it turns out the reduction in your necessary retirement spending is actually quite unsubstantial. So I say you go from maybe 4% to 3.3% or 3.8% to 3.2%. It's a relatively minor drop in your withdrawal rate over longer horizons.
Karsten, do you think that the financial system matured compared to what we had, let's say, 100 years ago? So then relying on that historical data is maybe not representative anymore and might be a bit more conservative. What are your thoughts on that?
Right. So and if you say it matured, it basically has two effects. One is positive and one is negative. And it's basically a horse race, and they may actually exactly cancel each other out, right? So in the sense that the system matured, in the sense that hopefully we will never have something like a Great Depression again, right? So we have a Federal Reserve that is a lot more responsive and a lot more understanding. Because we have less volatility, we could maybe increase our safe withdrawal rate. But then at the same time, I also believe, there's no free lunch. I think that may also mean that expected returns going forward are probably also going to be a little bit lower. So, and so people have pointed this out that, I mean, for example, the risk-free rate going forward is definitely going to be a little bit less than what we have seen historically. And then, so first of all, the risk-free rate is already a little bit lower, so which is what economists call the R star. So something like a rolling 3-month T-bill, what you've gotten historically versus what you get right now, especially in real terms, it's actually it's quite substantially lower. And then also, yeah, I mean, as you said, the system has become more mature. Maybe that also means that expected returns, so that basically the equity risk premium might also be a little bit lower because we might have less
volatility is going to be lower, right?
Volatility is lower. You need less of a risk premium. So I think it's it's definitely in the back of my mind, right? If we run any kind of simulation for safe withdrawal rates, what I'm simulating, is that really so bad that we can almost we could discard it or maybe discount it a little bit, but I also think that there's definitely the potential for lower growth rates too.
These days, when you do your simulations, what period do you normally use?
I have returns for all the major asset classes going back to 1871, not 1971, but 1871. And but yeah, I mean, obviously, if you want to run some of these safe withdrawal rate analysis, I mean, you could also say, well, maybe I ignore everything between the 1920s. So I want to have the Great Depression in there. I would completely discard the possibility that we have something like the Great Depression again. So I would want to keep that one in. And so say anywhere between 100 years to 150 years. So that's what.
But it's not something like 10 years of the
No,
data.
I mean, and again, if you do something like a 30-year rolling windows, well, you have to go back probably at least 100 years to have at least to cover the major economic disasters that happened in the past. And so the nice thing is, if you go back all the way to 1926, you have really all of the spectrum of what can go wrong with the economy, right? So we have what economists call a demand shock, right? Which means equities are down, but bonds are a great diversifier because interest rates go down. We have disinflation or even deflation. And we also have the inflationary shocks from the 1970s. Where people were, as recent as 2022, right? People were pointing out, oh no, I mean, we could have a repeat of the 1970s. So the nice thing is, if you go back all the 100 years, you have all of the different types of recessions. So some of it is more the demand side, some of it is a supply shock recession. So it means it's an inflationary recession, which means that normally equities are not down quite as much. But bonds are also not offering much diversification, right? So
speaking of bonds, we know that portfolio structure of the portfolio and holdings affect the safe withdrawal rates. You run simulation for different stock bond ratio, and in your analysis, we see that portfolios with higher percentage of stocks perform better. So the question is, do we really need bonds? Do people need bonds in their portfolio?
Right. So, and again, there's basically a trade-off, right? So if you have too much in stocks, the average return is the highest. So because stocks used to have the best average return, but then you also have much steeper drawdowns and more volatility, and you have less diversification. So sometimes it is actually best to have a little bit of bond portfolio mixed in. So the sweet spot historically seems to be somewhere around 70 to 75% equities and the rest in bonds. And that seems to hedge this risk that basically if your equity portfolio goes down just too much, I mean, obviously equities will always recover, but if you keep withdrawing, especially you keep withdrawing the initial amount and you adjust that for inflation, and you have some kind of really bad recession like 1929 to 1932 or during the 70s and 80s, you would compromise your portfolio so badly that even though the stock market itself recovered, but your portfolio did not because you just withdrew so much. It's basically the opposite of dollar cost averaging, right? You're selling more shares if equities are down. Whereas if you have some stock bond diversification, in some way, you could even make the case if the drawdown is relatively gradual and not too deep, you may not sell any equities at all, right? Because the equity market might go down, bond market might go up. Whatever you withdraw, you will basically effectively draw out of your bond portfolio. So you avoid this nasty effect. So it's basically the opposite side of the dollar cost averaging, where the dollar cost averaging hurts you, selling shares when the prices are depreciated. So you want to have some diversification. And so basically the safe withdrawal rates, if you plot them as a function of your equity versus bond weight, right? You can't have 0% equities, right? Because then you just don't have the return engine. You can't have 100% because then it becomes too volatile. And somewhere in the middle is the maximum, and that's most of the time. And it depends again on your specific situation, on the length of retirement, on supplemental cash flows. But it tends to be somewhere, I would say, between 60 and 80% for most cases. And so in the standard, very generic cases, I would say 75% is a pretty good first guess.
I would like to talk about variable withdrawal rate. Right. We know from research and aggregated bank data that family expenses vary during retirement. People tend to spend more in the first 5 years of their retirement, and then their spending goes down. But at some point, medical bills start to go up due to health issues. And at the same time, they may have also some additional income, such as social security, or maybe something else. So what does safe withdrawal rate mean if family has variable withdrawals?
Yeah, so I mean, first of all, I think for traditional retirees, there's definitely a lot of research that you will cut your withdrawals over time. Now, if you were really cynical, you could say, well, is it because people want to spend less, or because people have to spend less? Or because we obviously in the US, we actually have more of a problem of people under-saving than over-saving for retirement. Let's put it that way. But I mean, it's also true that even so, the people that have budgeted very generously, and say you have a very generous retirement budget, say in the 6 figures or even mid or high 6 figures, chances are, if you're in your 70s and 80s, you will probably cut this down a little bit because you travel less. And you might have the time, but you may not have the energy to spend all that money. So that is definitely true. Now, that is probably not something that I would translate into early retirement, right? So I definitely didn't see that between 2018 and 2023, and now 25 already, that my spending has gone down. I mean, it's definitely gone up with inflation. And especially also because my portfolio has done really well. So I now feel more comfortable to withdraw a little bit more. So not everything translates from transition traditional to the early retirement scenario. But yeah, I agree. If you already know that, say you are retiring at age 65, and you know that the first 10 years you want to travel very aggressively and then scale down, you could model that too, obviously, in retirement simulations. And who knows, that might make a difference. And you could increase your initial withdrawals a little bit because you know that later on you're going to spend less in retirement. So it should be modeled, and it might make a huge difference. Now, one thing that will not make a huge difference, especially not for early retires, where you say, okay, I'm in my 40s or 50s now, and I want to account for nursing home expenditures when I'm 85. Even if you put in some insane amounts of money, where you say, okay, I'm going to spend $200,000 a year on that when I'm 85, that's actually going to make a relatively small difference in your initial withdrawal. And the reason is that, so here again, is basically the long-term compounding helps you, right? I mean, even if you just cut your expenses early in retirement by a little bit, that is going to accumulate to such a huge sum that after 40 or 50 years, you can then easily afford your kind of the Ritz-Carlton level of nursing home. And so it's and again, so this is another way where people should look into looking at the idiosyncratic factors that of their personal retirement.
You brought up a very good point about the long-term care. Sometimes it might be a significant expense that might affect the withdrawals a lot. And you're right that testing that long-term care at a different age is also important, right? When doing modeling, because having that expense at 85 or 95, it's very different from having that expense, say, in 60, right? And one of the concerns that families have, or maybe that sometimes happens, is that one of the partners goes on long-term care and they withdraw more than they initially expected. So it's something that is a good idea to test. Also, I wanted to touch this topic is that families realize that they would like to pass money to their kids early, when they kids maybe 30 years old. That potentially might create a significant outflow. How do these big outflows actually affect the success of the retirement? Just would love to get your thoughts, and specifically on when there are not just variable withdrawal rates, but there is significant outflow at some point, whether it's long-term care or it's passing money to kids.
Right, and so it's mathematically, it's the same, right? So if you look at the two extremes, right? So imagine that outflow of, say, helping your kid or kids with, say, a $500,000 down payment for their house, and you had to do it right now. Well, I mean, that's very easy to simulate. I would actually take it out of my retirement nest egg and do my retirement as a completely separate exercise, and the net of the $500,000. If it is really deep into retirement, so it basically, there's some time value of money that you can apply, and how much money you probably want to set aside for that, and everything in between, obviously, right? Another thing that I would probably do in that case to make the simulations a little bit more reasonable, if you set, so imagine you already know that in 2037, you need to come up with $500,000 to give to your kids. Well, what if the stock market is down just terribly in 2037? Maybe you probably have a little bit of flexibility into, well, if I don't give $500,000 in 2037, maybe I can give it in 2038 or 2039. So in some way, whatever you simulate, right? So, I mean, obviously you can structure some kind of a withdrawal simulation, and then
is it some sort of Monte Carlo simulation that
in a Monte Carlo simulation, or with historical simulations? Right? It's even more extreme in historical simulations, because if the market tends to be down in 2037, there's a higher likelihood that there's a big recovery in 2038, or the other way around, right? You might realize that while the market drops a lot in 2037, you probably might have given the $500,000 for the down payment already in 2035, because the market performed so well, and then right before the big thing, before the bottom fell out, you already you could afford giving the big gift to your kid. So obviously you can simulate all of that, and the nice thing is, whatever you simulate, reality might actually play out in a way that might even be a little bit better than what you simulate, right? Because it's hard to simulate this conditionality, right? So I give the money, but only if I can afford it, and if I can't afford it, I might give a little bit less, or if I can't afford it at that point, I might just give it a year or two later. So what you simulate might actually be a little bit of a worst case scenario in that case. So,
Matthias, before we go too far away from portfolio construction, and Matthias is asking another question: do you use UOB glide path into retirement, and what is the portfolio composition between equity bonds, 30-70 to 80-20?
Right. So there's actually quite astonishing results out there, which are actually at odds with the way glide paths are structured by all the glide path providers. So, and there seems to be consensus that going into retirement, while you're still working, when you're starting out, you can be very aggressive on the equity side. And then once you get closer to retirement, you should be at something like maybe a 60-40 portfolio. That's what probably most glide paths would use by default. But then there's been research that once you're in retirement, you want to go almost the opposite way. So, and the way this opposite way works is that, so, and this works mostly with historical simulations. Because you have this feature that many times you might have a bear market, but then coming out of the bear market is really the stock market usually slingshots out of that, and you have a very strong recovery. And so there's a reverse glide path during retirement, right, where you start with a little bit more bonds, a little bit less stocks, but then you go back into higher stock allocations. That helps you because, so it does two things, right? One is a long-term, you have, again, higher equity allocation. You have this growth engine, and that's going to be able to afford your, say, your 40, 50, 60-year retirement. But short-term, you hedge against this short-term sequence of return risk. And so again, the nice thing is that if you not just keep a fixed asset allocation, but you shift up very slowly your stock allocation over time. If there were to be a recession in the near term right out of the gates in your retirement, you would avoid a little bit liquidating equities. And then you might actually do, so you sell your bond portfolio while you're retired, and you might actually withdraw more from your bonds and put it into equities. And then you get a little bit of this dollar cost averaging back into equities. And, and again, the glide path like that is going to hurt you if there isn't a recession and a bear market, right? Because then you say, well, then you probably should have been just high equities all along. But it's essentially an insurance mechanism, right? So you, in the best possible case and outcome of the world, you lose a little bit, but that's the time when you don't really have to worry about running out of money. But if there is a bear market right out of the gates, then you do better with this glide path. And it's quite intriguing, and it's so intriguing that so that's the result is intriguing. It's also intriguing that this hasn't been implemented yet in any of the glide path families. So basically, if you look at Vanguard and T. Rowe Price and Fidelity and all the big providers that run these target date funds, once you're in retirement, you actually shift further out of equities and you become less and less equity centric. And you should be doing the opposite. And it's quite amazing that this hasn't really caught on in the financial world.
And someone Andrew shared the link on your article about the glide path. So if people want to learn more about that, I think it might be a good starting point. I want to talk about taxes a little bit. So families normally have their assets spread across multiple accounts with different tax treatment. There are taxable accounts that are taxed using long-term capital gains tax brackets. Tax-deferred accounts are taxed as ordinary income, and there are, of course, tax-free accounts. How do tax affect withdrawal rate calculations, and how one can take that into account?
So obviously, the tax situation can be so different from person to person. So in my toolkit and a lot of the research that I'm doing, I'm not taking that into account. And basically what I say is these withdrawal amounts are really all before tax. And you have to do two things. You have to apply something like a haircut, basically a retirement average tax rate, and knock out so somewhere between 0% and probably somewhere double-digit percent. And so in that sense, obviously, safe withdrawal rates don't really scale, right? So somebody with $1 million portfolio who withdraws $40,000 a year is going to have a very different true consumption rate out of their portfolio than somebody with $100 million who withdraws $4 million and then potentially has to tax a lot of that. The people in the US are actually quite fortunate that our effective tax rates in retirement are actually relatively low. Right, so I've recently done a one-on-one advising session, and so it's a couple with a 7-digit portfolio, And they can basically structure their withdrawals to have zero federal income tax. So basically, they fill up their standard deduction, which is, I think, a little bit over $30,000. So they can fill that up with ordinary income, and then they can do another something like $90,000 in long-term capital gains that are not taxed at the federal level. And even though they have very substantial amounts of money in 401ks, so basically what they do is they're still very young, and early on, you basically max out your so you do a Roth conversion from a regular IRA into a Roth. So every year you shift over $30,000 from your IRA into a Roth. So that eventually becomes completely tax-free. And then out of their taxable accounts, they live and pay the bills. And then eventually is actually their 401ks and IRAs are going to be low enough that eventually you have these required minimum distributions that are going to hit you. But by that time, they've already chipped away enough from their from the 401k plans that even at RMDs, they're not going to slip into a higher tax rate. So we are actually quite fortunate in the US where you can live off of your capital income. And I mean, it's $120,000 for a couple. That's a pretty neat retirement if you structure this right. And
especially if you don't live in the Bay Area, in the San Francisco Bay Area,
and you live somewhere else. And I mean, you live here in my town in Southwest Washington. You can have a pretty nice retirement. So yeah.
That was one of the reasons I asked like where you're joining from today, because it's quite interesting to see like what was your choice. That's true. I think you're right that most people don't realize that their taxes in retirement are going to be lower. That said, it depends on their structure, like how much they have in taxable versus tax deferred accounts, and it's all individual. What's interesting about these conversations about the withdrawal rate is that most of the time people assume that withdrawal rate is going to be constant, and just in these formulas and the calculations, right? But just for simplicity. But I'm wondering how many families actually don't have that flexibility and they need to stick to that constant withdrawal. Do you have any insight into that from what you?
Right. So a funny thing is, I don't think I have known anybody who has ever retired who has done basically the Trinity study or the Bill Bengen style 30 years of retirement and basically set it and forget it and withdraw the same amount every year. So part of it obviously has to do with, I mean, just your spending might just fluctuate because, well, you have home repairs and you have to replace a car. I don't think that's really a huge issue because if you have some fluctuations in your spending around a mean, right, and you simulated that this mean is what your portfolio allows you to withdraw, and then you have a little bit of fluctuation around it, that's actually that doesn't really have an impact on your retirement and on the safety of your retirement, right? If the mean is such that, well, I budget my retirement at $40,000 a year, and then every second year I spend $60,000, and every second year I spend $40,000, then you might have a problem, right? But if it's the other way around, right, where you say you simulated your retirement and you think on average you withdraw $100,000, and then every year you get basically flip back and forth between $80,000 and $120,000, that's actually that doesn't really have a huge impact on the sequence of return risk. And again, I don't know how many physics or math or statistics PhDs are in the room here. So it's basically you look at basically at the frequency of your fluctuations in your spending. If that frequency is much higher than, say, the business cycle fluctuations and the depth and length of recessions and bear markets, then those kinds of fluctuations don't have a huge impact on your retirement safety. It's just basically, it has to do with the frequency of your your fluctuations versus the business cycle fluctuation. So that's something that you shouldn't really worry too much about. You could so that's one part that you could have variable spending. The other part where you would have variable spending is that obviously, I mean, and this is actually also the mathematically correct way, strictly speaking, when you do safe withdrawal rate analysis, you should have basically a time consistency in your retirement plan, right? So think about it as, so I retire today and I have a horizon of say 50 or 60 years. The next year, now I have a 59-year horizon and I have this portfolio level. Why should I still spend the amount that I calculated last year? Shouldn't I run a new retirement simulation right now and re-optimize and see what would be the new spending level given today's portfolio, today's horizon, and whatever might have changed in your life, right? I mean, you might have realized, oh, now I have a health problem, or you didn't have a health problem that you thought you might have had, so it could be a positive or negative effect. So, so in that sense, maybe think about it as re-retiring. Maybe not every day, not every month, but maybe once a year you update your retirement plan, and that will obviously create some volatility in your withdrawals and
variability in terms of like
right. So
I want to make sure that people who join us on the call today, they also get an opportunity to ask their questions. So please, if you have a question, you can just raise your hand and ask it, or type it in the chat if you feel more comfortable. And meanwhile, I just wanted to ask, while we're waiting for the questions from people, Karsten asked the idea how people can deal with this complexity, right? When they have variable expenses, variable taxes, right? What is the approach you think you personally have been using so far to navigate that complexity? And
right. So I think it's best to use the tools that are out there, right? I mean, Alex, you built a tool. I built a tool that is much less detailed on the actual tax situation, right? So I take a little bit of liberty and shortcuts on the tax situation where I say, well, I can run some simulations, but the tax, you have to clear that yourself and basically tag it on at the end. So, but yeah, I mean, there are a lot of nice tools out there where people can run simulations. And I think one of the reasons why there is actually oversaving in retirement. Right? We talked about the other side of the problem, right? Where people they are 60 years old, they have zero savings, and so that's undersaving. But there are also a lot of people that oversave, and they say, "Yeah, I mean, I heard about the 4% rule, and but I don't trust it, and this is all just a bunch of technical mumbo jumbo." So in the end, the people then just retire and only withdraw 2% because they say, "Well, is what these academics ran in the Trinity study and what Bill Bangen, not an academic, but is basically a practitioner, but also ran a very generic study. What these people simulated there is just so unrealistic for my situation. So just to be on the safe side, I'm withdrawing only 2%. And and it turns out maybe their specific situations might have, yeah, I mean, 4% is bad, but you should have gone on the other side, or you could have withdrawn 5%. So I think doing more and simulating your retirement and using the toolkits that are out there, I think will set you free. And that's definitely what happened to me, right? Because it's not like I'm going to give up a nice job in the Bay Area, and I had a nice window office in San Francisco. It's a pretty nice, sweet deal there, and I wouldn't have given that up just listening to somebody on the internet talking about the 4% rule. I needed to do that analysis myself and give me the confidence, and then also convince my wife that, hey, I mean, I'm going to give up my job and I'm just going to move to Washington. Are you okay with that? So yeah, I mean, she probably was also convinced you're kind of a math dude, and you probably did the math right there. So let's do it. So
How much time did it take for you to convince your wife?
No, I mean, again, I mean, we have been married and we have known each other for the longest time. So, I mean, obviously, it's not like I just told her on January 1st, 2018, hey, let's do that. So we have been planning this for some time. So it was not a process of convincing her. So we've been planning this for a long time, and she was always in favor of that. Yeah.
Then left a comment. You're the one that's given us the confidence. Retirement.
That's good.
Yeah, I think it's a nice compliment. You wrote Karsten. You wrote a blog post about the Die with Zero book by Bill Perkins.
Right.
Which I personally found quite interesting. I mean, both book and in your blog post. And I want to talk a little bit more about the oversaving problem, because very few people talk about that, but it's real. And would love to get your perspective on that. It's like, what are the tools if people want to make sure that they are not oversaving, right? And what can they do for that?
Right. So, and again, do your math right, and then leave some wiggle room, right? And obviously, you could say that you will never avoid oversaving, right? So I compare this to an example. So imagine you rented a car and you accidentally prepaid the gasoline, which you should never do. It's way overpriced. But imagine you made the mistake and it's a sunk cost. So now you know that, I mean, you don't want to leave any gasoline in the car. But you're still going to return it with probably 1 or 2 gallons left. I mean, it's not like you want to get to the airport driving on fumes and risk running out of gas 4 miles before the airport, and you miss your flight, and the car is damaged or something like that. So there are lots of situations where we always err on one side, and we are okay with oversaving, right? Another example is when I go to the airport, I leave home in such a way that I know I don't miss my flight. Right? I've missed a lot of connecting flights, but I've never missed a flight where I was in charge, and it was my responsibility to be somewhere on time. And so I would do the same thing with my retirement, right? So if I'm not willing to miss, say, 20% of the flights I'm taking, I'm also not willing to have a 20% failure probability with my retirement. So in some way, I am 100% set up for quote unquote failure in the other direction, where I oversave a little bit. So I think we should not fault people for that. That is just a natural thing to do, that there's an asymmetric risk where, or I'm hiking somewhere and I walk a little bit to this side because, well, on this side, I might hit my head. On the other side, I might fall to my death. So I know which side I want to err on, and it's the same with retirement. So that makes sense. It's not bad to err. And then on top of that, right? So there's basically ex ante versus ex post optimality, right? So ex ante, you obviously account for all the possible things that could go wrong in your retirement, right? You could have some health problems later in retirement, and then, well, maybe you don't have the health problems and you have some money left over. So I'm not too worried about a little bit of oversaving. And then on top of that, right, obviously, if your retirement progresses, again, use the tools that are out there, your tool, my tool,
adjust.
And then you see you have, okay, now I've overspent, I have oversaved, but now I can give away some of my money and help charities, help your kid or your kids. So again, the math and the tools set you free, and they would assist you in that. So
Julian is asking about the protection. Do you have thoughts you would like to share about income annuities? What is your
income
take?
Annuities? Right. So I personally don't. I actually, or I do have one, but that's against my will, because it's still it's a pension from my old job. And I think at age 55, I become eligible drawing on that pension. I can understand that now, where interest rates are a little bit higher, that people look into annuities. So The problem with annuities is that the best kind of annuity that is actually relatively low fee, because there is a lot of competition, and it's almost like a commodity, is basically the single premium immediate annuity, SPIA. And that's actually something, even though it's an insurance product, and a lot of other insurance products are just wildly overpriced. So the SPIA is actually something that you can shop around, right? And then you say, okay, this is my age, and I want basically an immediate annuity, and I'm taking a little bit of my big chunk of money, and then I transfer that into a regular payment. I think that works quite well. The one concern you should have is that, well, this product that is actually a commodity and low fee is nominal, right? You get the same nominal payment. So basically inflation chips away a little bit of that monthly payment, which is okay, right? Because I mean, maybe some people say that, yeah, I mean, I'm probably going to spend less over time anyways. And then you let inflation chip away and you say, well, it's maybe 2% a year. Of course, what could happen is, well, what happened over the last 5 years, right?
Yeah.
Instead of having 2% on average per year, we had 4 or maybe even a little bit more than 4%. So that's the inflation risk, and so you could do that. So an annuity would be one way. Something like a tips ladder would be another way, where you don't have that inflation risk, but also you don't have the longevity protection, because that's, I mean, you transfer a fixed amount of money into a set number of payments, but once the payments are done, right, you're out of the money and you're out of the payments. So I mean, there are ways to basically, and it's called, this approach is called safety first, right? And especially over shorter horizons and for traditional retirees, there is some appeal to that. For very young retirees, normally the tips ladder and the annuities, I would not put a big chunk of my portfolio, if okay, at all, into either a tips ladder or an annuity. So keep enough left over that has some inflation protection over the long run, something like a stock market index.
Yeah, thanks for sharing your opinion here, Karsten. Bruce is asking, I think it's more specific question about the tool. In our toolkit, SWR/ACR is scaled directly to the S&P. So now we can update ourselves. Is it ever updated in a way beyond that scaling? Can you speak a little more about how one chooses the 1.75 or 1.5 intercept? Is there a guidance for that?
Right. So this is an extremely specific question, right? And to just fill in everybody else. So there is a way to set a variable withdrawal rate out of your portfolio. That's not just a fixed number, right? For example, you could say every first day of the year, I withdraw, say, 4% of my portfolio. And that way, if the stock market is down, I'm going to withdraw less. If the stock market is up, I'm going to withdraw more. And then basically this way I roll with the punches, and you shouldn't run out of money that way, because you lower your withdrawals if the market is down. A little bit smarter way doing that is to also factor in equity valuations into your withdrawal rate. Right? So your rate of withdrawal depends on how expensive the stock market is. And now this becomes a little bit, part of it is art, part of it is science. So one way to do that is to look at the CAPE ratio, and instead of the CAPE ratio, you do 1 over the CAPE ratio, which is the earnings yield. So right now we have a CAPE of somewhere in the 30s, so that means the earnings yield is really only somewhere around 3%. So you don't withdraw the earnings yield, you withdraw maybe only half times the earnings yield, but then you also put an intercept to, because you want to withdraw at least something every month. And so playing around with these two parameters, right? What is the slope parameter on the earnings yield, and what is the intercept? So obviously the higher you set the intercept parameter, the more you can withdraw, but also the higher your risk is that, well, if you start way too high, basically your average withdrawals over your retirement horizon is just going to be a very steep path down. And then if you're 80 or 90 years old, you may not have the purchasing power. So it's basically you have to play around with the parameters a little bit to see historically how that would have worked out in some of the worst case scenarios, or kind of average case scenarios, or best case scenarios. And yeah, again, so you need basically the help of some simulation tools, and that's so we're talking about kind of the basics of retirement, and this is kind of retirement, kind of PhD level, 501 level retirement. So, I mean, that's, and I think I'm going to leave it there because I don't want to lose everybody else. So.
Awesome. Thank you. So we talked briefly about portfolio and stocks and bonds allocation, but I wanted to make sure that Joe's question is also answered. The equity risk premium has gone down in recent years as interest rates rose and equities got expensive. Long-term tips are paying 2.6% real. Is there a point where the equity risk premium becomes too small or negative that we should increase bonds in our portfolio? That's the question.
Yes. So I personally think that if I were to put together a retirement portfolio, the initial retirement portfolio, I would probably lean more towards maybe something like a 60-40. And again, this doesn't have to be done forever. Right, so you could do it something like through a glide path, and so where later on you shift into equities again as equities become a little bit more palatable. But yeah, I mean, so basically the math between equities and bonds is really under attack from both sides. By the way, it used to be the other way around, but now it's bonds are again yielding some pretty decent interest rates, and equities are just so expensive right now. In the past, whenever this was the case, and again, you can never time exactly when is the turnaround point for equities, and when is the bottom going to fall out. If you had done this in 1996, right, and I have to shift out of equities and go into bonds, and then you see equities are still performing so well until 2000, you would have just kicked yourself. So eventually you're going to be right. Getting this exactly correct is really difficult. Now you could say that if you've already won the game, right? If you say, imagine you are retired already, and so this is really something for retirees. If you are still accumulating and you're just starting to accumulate, 100% equities is probably still okay. But in retirement, right, if you've already gotten a portfolio big enough, yeah, I will totally support going down to 60-40. I think Vanguard recently said, well, their 60-40 is their standard, the strategic asset allocation. They want to go down to 30-70, so 30% stocks and 70% bonds. But again, so this is from a baseline of 60-40. They will go down 30% less equities, 30% more bonds. So I could definitely say, if I would start with something that I say maybe 80-20, you have 30 percentage points less equities. Yeah, some people would then say, yeah, 50-50 is not a crazy assumption. It doesn't have to be forever, right? You can shift back into equities over time.
We're out of time, so maybe just one question that I wanted to ask you, Karsten. You've been in retirement for 7 years.
Right.
Is there anything that came as a surprise to you during these years?
Right. Yeah. I mean, what came as a surprise is I'm still very busy. Right? So that's actually the concern, right? Am I going to be so bored that I want to go back to work? And in some ways, I'm going back to work because I'm doing this, right? I blog, I go to conferences, I go to podcasts. I have a little investment advisory firm that I run on the side, and it's a part-time, not even half-time. It's less than half-time. So yeah, I mean, I'm amazed at how busy I am still, and my wife is very busy. So we volunteer a lot at different places, at church, at school, at our daughter's school. So we coach teams. My daughter is doing all sorts of fun activities at school, robotics and math team and stuff like that. And my wife and I are coaching there too. So we're still quite busy, and I'm kind of amazed at how can people lead normal lives with kids and a house and a mortgage, and also have a job. So I don't have a real job, and I still feel quite busy. So that was a bit of a surprise.
Thanks for sharing that, and thank you for joining us and educating on safe withdrawals topic. If people have questions for you and want to reach out, what would be the best way for them?
Yeah, I have a blog, earlyretirementnow.com. There is a contact page, so you can reach out there. And I'm on Twitter, so I think that's also part of on my blog. You can find that Twitter handle. I don't really do Facebook very much, so don't reach out via Facebook. I might be 3 months late in my reply there. But Twitter and email via the blog, that's usually the best.
Wonderful. Again, thanks, Karsten, for joining us today. Everyone, our next session is going to be on September 26th. Simone and I will be talking about the portfolio construction and modern portfolio theory. You can sign up on our website. Also, if you have suggestions about the guest speakers on the topic we should cover, please let me or Simone know. Would love to get your ideas. And I will see you in 3 weeks. And there was a question about the recording. So yes, we recorded this session and we'll send it to everyone who signed up. Thank you again, and see you later. Bye.
Thank you.